Hello, everybody. So today I want to talk about stocks for rate cuts and getting ready for rate cuts. Of course, we should have had rate cuts many months ago. Because of purchase, because of political reasons. I believe we have a political Fed now. Those rate cuts are not happening. But here's the thing. The rate cuts, they're going to come at worst May 2026, because May 2026 is when we get a new chair. And so for me, it means that it's time to start positioning, because even if Powell doesn't drop the rates until May 2026, the market will start anticipating rates coming with a new Fed chair to be nominated. And there will be an announcement probably in the coming weeks, maybe months, about who is going to replace Powell, who Poaches is going to nominate to replace Powell, and I expect this person to be oh so dovish. This is the look that I expect for the new Fed chair person. I think just knowing the name alone could drive up the markets. The rates in anticipation of a dovish chair, the rates could drop. Quite simply, they could drop. We could see the 10-year drop, and I think this could have a beneficial effect on a lot of stocks early, even before the rates drop, right? Even before we actually get a new Fed chair in May 26, even before that, I believe they should rate. Of course, the CME FedWatch tool tells us the rates are coming, but that tool doesn't take into account things like the change of heart of the current Fed chair. That tool was guiding for cuts a long time ago. That tool was already telling us cuts were coming. And of course, the politicization of the Fed makes it that we haven't had cuts, unfortunately. So what stocks am I looking at for cuts? What stocks do I think are poised to benefit from those rate cuts? Well, the first stock that I initiated a position in and that I'm going to keep building on is REAX. REAX is The Real Brokerage, is the name, ticker symbol REAX. I made an analysis on it, a full analysis 2 months ago, 30-minute analysis. Feel free to go take a look at it. I believe this is the next best strategy after Open Door. Right, my beloved Open Door. If you remember the early days of the channel, Open Door is one of my losers. I own it. I think the Fed killed it. The Fed killed a lot of companies. Open Door was at the, to me, they had an amazing business model, but at the wrong time. And so unfortunately, Open Door is now struggling. And so I'm not backing Open Door. But I do believe that there will be a disruption of real estate agents. The 6% fee has to go. The transaction fees on real estate, it's going to be a secular thing. They're going to go down over time because transaction costs are not a thing in the era of digital, in the 21st century, in the era of customer satisfaction. Paying 6% to sell a house is going to be less and less of a thing. And my bet in this sector, my bet on this revolution, and this time I want this bet to be helped by the rates dropping. My bet in this sector right now is going to be The Real Brokerage. The Real Brokerage has a very different approach. Their approach, if I were to summarize it, is to try to take the top performing agents away from traditional brokers. You know, in any broker, any company, any sales organization, you're going to have your top 20% performers who do 80% of the sales. And the way the Real Brokerage has really set up their offering is they've set it up to essentially hire out the top performing agents away from traditional brokers into the Real platform. And, you know, it kind of creates a situation where the traditional brokers are only left with not the top 20%, with the lesser skilled or lesser connected agents. And when I follow, you know, just do a search on Real Brokerage. Real Brokerage, you'll find many more analyses online of real estate agents talking about it and about how they're excited about it rather than investors. Very few people look at it from an investment standpoint. Most people look at it as to, oh, should I leave my REMAX? Should I leave my Coldwell, whatever, bank, whatever all of these old world brokers? Should I leave my broker to join Real? And you see people are very excited. Realtors are very excited about Real. It's an asset-light business model. It's growing fast at 45%, and they're growing this fast in a very adverse real estate market. They're growing this fast in a, dare I say, in a dead real estate market where very few transactions happen. And so the question, for me is how well are they going to do when transactions pick back up? When rates go down, how well are they going to do? I believe they will greatly benefit from a drop in interest rates because as soon as interest rates go down, people have been postponing home ownership, people have been postponing moving, they've been postponing finding a new job, and the transactions in real estate will pick back up at some point. We can't be stuck for 10 years, right? We've been stuck in real estate for 3 to 4 years. It's going to unlock with the new Fed, with the new lower rates. That is at least what I believe, and that's kind of my bet. My bet is that my new bet on real estate is this one. So we'll see how that goes. But I like Real very much. I'll analyze it again for the channel. That's my next big analysis for this channel is going to be Real. I did Caspi for the Patreon not long ago. 2 days ago, I did Caspi. Expect another full deep dive on Real for the Patreon within the next few days. Moving on, second stock I'm curious about, which could really benefit from rate cuts. And of course, that stock is GigaCloud Technology. So this stock, a lot of people disliked it because Chinese association or a Chinese tilt. Of course, the Chinese make a lot of furniture. They make a lot of bulky stuff. GigaCloud is a B2B marketplace. So it's not consumer facing, right? It's not a Wayfair. It's, let's say you want to buy furniture online, you want to buy furniture on Amazon or whatever website you see on Instagram that sells furniture. Oftentimes on the back end, there will be a platform that, contacts the supplier, the maker of a good in China, and then transports the good and then delivers the good to your customer, and you don't have to do anything. And it's that platform. That's what GigaCloud Tech does. GigaCloud handles all of the back end, and then you can be either a local showroom in a small town, physical showroom, or you can be just a very agile, small furniture website that mostly gets leads from Instagram. And then what do? Well, you just sell products that you find on GigaCloud, this dropshipping platform. And so your skill as an entrepreneur now becomes, highly curated selections. That becomes your skill, your ability to spot this big bulky item, this big furniture. Anyways, the point I'm trying to make here is when do you sell furniture, right? When do people buy, I don't know, a new faucet, a new fridge, a new equipment for kids, a new trampoline? People buy this stuff when they move. The furniture is sold heavily when people move. When people move, it's an opportunity to throw out the old and start anew and start fresh. And I believe furniture stores are the type of stores that could benefit from this. And of course, I much prefer a furniture store to not have physical operations because physical operations cost a lot of money. They eat into your margins. They're just not as attractive as a business. This is a fully digital business. This is much more attractive. It's not entirely digital. They have trucks, they have warehouses, but they don't have commercial real estate, I guess is the point I'm trying to say. And so I find that compelling. The stock is down 36%. Of course, it still has a little bit of a China association, but the big question is China going to be investable again now that we have trade negotiations, now that I mean, based on both parties, if there's been a trade deal, we don't know much about it. But now that the tensions are down, is China going to become investable again? And again, to me, this is not a straightforward China stock. To me, this is a California company. But a lot of people saying there's a Chinese association. Kind of the same issue with SMCI. Like a lot of people say the same thing with SMCI. And people like to throw shade at China risk for companies that are clearly incorporated in the United States. So anyways, that's kind of my take on this. I think they could benefit from that. It also aligns with my belief that a lot of people look at hardware stores like Home Depot or Lowe's. They say, oh, these stores are safe. I personally don't believe so. I think a lot of people are going to buy hardware. They're going to buy a lot of the do-it-yourself type of stuff. I think a lot of people are going to buy it on Amazon. You can buy a lot of stuff on Amazon. Did you know you can buy plants on Amazon, for example? I bought plants the other day on Amazon, like full pots, everything. You can just buy it on Amazon. You don't have to have a truck to go to the store. So anyways, that was a tangent. I think they could benefit from a drop in cuts. Another stock. So this stock, I still own this stock, but I'm positioning in a little more. I'm trying to see when I enter this stock. Even if I enter this stock deserves another full analysis. This stock was doing great before the rates went up. Actually, it was doing stunning. It had nice top line growth. Very, very exciting margins, 80% margins, 28% EBITDA margin. You can see still today. This stock is predicted to have lower sales next 12 months, -6% in sales. And this stock has been struggling as far as the top line revenue goes. This stock has been struggling for 2 years, almost 3 years. Also, if you look at the drop in the stock price, it tends to trade in line with the conflict in the Middle East, because it's incorporated in Israel. So you also have the geopolitical risk on this stock. So the stock, unfortunately, hasn't had a lot of good luck with the market INMode. They haven't had a lot of good luck between the geopolitical tensions and between, of course, the lack of purchase of equipment from doctors because of the interest rates. So so what do? They are a hybrid between injections like Botox and frown line injections and cool sculpting, whatever it's called. They're a hybrid between that and a full-on plastic surgery. So what does INMode do? They're a micro needling company. They use micro needles to melt fat. They suck fat out of skin. That's whatever. It's the business. I care about the business. I don't really care about the product. The point is the business is very profitable. Why is that business very profitable? Well, their equipment, and you can see they have an extensive line of treatment. These equipments, these machines, they go between 90K and 150K. And the problem is that they haven't sold a lot of these machines because doctors, clinicians, physicians used to pay 6 to 7% interest to buy these machines, and now they pay 14 to 15% interest to buy these machines. What is 15% a year per year over 5 years? That's a double. So a machine that's $100,000, if you borrow it at 15% interest only, 15, that's a double in the cost of the machine. And so paying 15% interest to buy a machine like that hurts your sale tremendously. And this company, they want to start selling an I think it's $90,000 now, $90,000 fat melting machine. If they want to sell that machine, they need to have low interest rates. And low interest rates is very much the topic of this video. That's what I think I'm going to get. So what I think is when low interest rates come back, physicians will okay, well, I want to expand my beauty practice, and let me just buy the next Orpheus, whatever, and then they make a lot of money on these machines. But noteworthily, this company has been surviving on the sale of consumables. These, the tips, the ends of these machines, you probably can't see them, it's too small, but you see each machine comes with a custom tip, a custom microneedling end. These tips, they go for $100 or $150, depending on the volume, etc. And of course, a patient needs 5 or 7 treatments on these machines, and every time the tip has to be thrown away and you have to buy a new tip. So every time the microneedling tip costs $100, $150, and that's next to pure margin for INMode. So they have a big consumable business, kind of like the printer at home, the printer business. They make a lot of money on the cartridges. This company makes a lot of money on the microneedling tip, in addition to making money on selling the machines. I think this is a stock who is poised to get re-rated when drops rate and when sales accelerate. And in the meantime, they've made good use of their cash because they have bought back their stock. They have returned more than $412 million to shareholders. They've bought back approximately 27% 5% of their total capital of the shares outstanding. And so that's very impressive. And that's why now you have a stock trading at 4 times EBITDA. So this stock is trading like a struggling shopping mall or like a struggling clothing store. And it's doing that in frankly, an industry that is at the forefront of society. If you look at modern society, if you look at Instagram culture, I don't have Instagram, but I know Instagram culture. They're all about this stuff. They're all about this stuff. You gotta look good on those videos. You gotta look good on TikTok, and so a lot of young people, a lot of women are very, very sensitive to these cosmetic procedures, and it's a value cosmetic procedure compared to a full-on surgery because it's a microneedling, and so it's cheaper, and you can end up paying for a full belly reduction or whatever, and you can end up paying $6,000 or $7,000 for a full belly reduction versus $25,000 if you were to go through a traditional surgical route. And so that's why I think this business is poised to bounce back. We just need to bounce back on the rates, on the interest rates. Anyway, stock number 4 I'm positioning in. This stock has run quite a bit. I don't like that run. I know a lot of people are excited. This stock has been in the valley of despair for 3 years, but I don't like that run. I think the opportunity is almost gone on the run. This stock has been running so high, but for SoFi, I have a very and this is not a stock I follow on the daily. This is what I consider a sleep well at night type stocks, mostly because it used to be too cheap. If it's going to go in the 20s, it will not be sleep well at night anymore. I think in the 20s, I think the stock will require monitoring because the valuation will warrant it. But when this stock was trading at $12, frankly, the valuation wasn't bothering me at all. The simple is keep it simple, stupid. That's the thesis for me. The thesis for me about interest rates. How do interest rates impact SoFi? So I know, of course, on these highly followed retail stocks, it's kind of like people are always bullish, and so people are like, oh yeah, well, high rates are good because we are going to make money on deposits, right? Because we don't give out as much on the deposits, and we make money on the back end on the yields, and so we have this float. We have all of this money on the checking account. And we give way less on the checking account or next to nothing on the checking account, and then we make money on the back end, right? And that's something that you see more for like a big bank, like a Chase. Imagine a bank like Chase. They pay 0 on their checking account, and then on the back end they make 5%. That's how they make money. But I would argue this kind of like always bullish or I'm always winning look at banks is a little been misguided, because in my view banks make way more money loaning money. Okay, they make more money with loans. And there's a few assumptions for that. Why do they make more money with loans? Well, one of the big assumptions that you'll find in the field of banking is that everybody wants to borrow money at cheap rates. There's always demand for money at cheap rates. It's much tougher to sell a loan, though, when rates are very high. And when rates are this high, it's tough to sell a loan, right? People are less likely to get a kitchen remodel or to get a jacuzzi or a destination wedding, you name it. They're less likely to do that right now because personal rates on loans is what? 11%, 12% if you're super well qualified. And so people are like, okay, I'll wait for rates to drop. It's less compelling if you get that sticker shock. You see a loan rate and you're like, okay, I have to pay $30.99 for this loan. You're less likely to do it. So the demand goes through the roof when the loans drop. When the rates drop, I think the demand will go through the roof. When we, and you may remember this from 2018, 2019. I remember I was driving on the freeway. You had the local credit union advertising a car loan for 0.99%, and you had banks advertising the loans. The cheap rates create enormous demand for loans, and so I think banks make more money when rates drop, because they loan more than they do on deposits. They make more money when rates drop than they do on deposits. At least that is my take. And additionally, for SoFi, I think the student loan refinancing business could make a comeback. And I know it's a small portion of the business of SoFi right now, but actually, even if it doesn't make a comeback for real, it could make a comeback at least as a narrative, because you have a lot of people on Wall Street who still view SoFi as a student loan company. I know this story gets old. This is now like a 5-year-old thing. That's not what they do. I mean, it's a very small portion of their business anymore. But I see it on X. You still have people who just dismiss SoFi as this student loan company. So student loan refinance business, even that could make a comeback for real, but also at least as a narrative if rates drop. Because when rates drop, people refinance their mortgage, people refinance their loans, people go out and borrow money. This is just the nature of the American economy, and I think that could outsizedly benefit a company like SoFi. And the last company, stock number 5, is Tesla. So Tesla is a little bit of a wild card because, as you know, I don't own Tesla for the core business. I don't judge Tesla for the core business. But analysts judge it as such, and analysts comment on it as a core business. The media comments on it as a core business. People who don't follow Tesla closely judge it as a core business. And so are we going to have a short-term catalyst because of the rates, right? Because of the interest rates for selling cars, and demand for cars going to go up with interest rates going down. I think over the short to medium term that could be true. First of all, a lot of the market rates right are due on expectations. So like I said, if we had a new announcement of who the new Fed chair is going to be, even if we have to wait now 10 months to get the new chair, if we just know the name of that new chair, and if the market realizes how dovish that new chair is going to be, then the market rates, the market interest rates, right? Because it's the market interest rates, the market interest rates are correlated to the Fed funds rates. But it's important to realize that the Fed also only decides the Fed's funds rates. The rates are mostly market decided, and so the market rates could drop in anticipation of a drop of the Fed's fund rate. So just a new announcement could be a catalyst, because we could see the rates drop a little bit within the coming months. And if you add to that the fact that the EV tax credit now with the one big beautiful bill, HB1, passing the House and being signed, now that bill is going to become a law, the 7,500 tax credit for electric vehicle is going away on September 30th. So people could not only get lower interest rates, they could be rushing to go buy an electric car, and you have the tax deduction for the rate. So you have 1, 2, 3 things going in favor of selling cars, going in favor of the business that Tesla is still judged on by much of the market. And so I think this could be bullish for a lot of the auto sector, and especially for Tesla, because Tesla, of course, is a pure EV play, and EV are all about the $7,500 tax credit. That has driven some sales, right? And that could keep going some sales. So Tesla is kind of a bit of a wild card in there, because of course I don't judge Tesla for the core business, but I also think they could benefit from the rate cuts, loading the rate cuts incoming. So this was not financial advice, not investment advice. This is only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.